Right, so in this lecture, we are going to study national income accounting. So essentially, so this is a chapter explain how we measuring our economy. So this is the first measurement we're going to do. Right? Like I explained in the introduction. So once we enter the territorial macro, so we start with measuring the economy. And then so we'll make sense of those numbers we measured. And then finally, we talk about policy. That's how we structure the class. And then in this module, we are going to measure in different things. Like this chapter, so we are going to measure in GDP, which is measuring size of the economy. We also learn how to measure in the price index, like inflation or deflation, right? Okay. First, just trying to motivate this lecture or this chapter. So why we care about this measurement? The question could be, okay, so how we measure an economy and why this is relevant? It's like, so if you read the newspapers, right? So back in 2010, so the headline said China plus Japan as second largest economy. Now today, so if you read the news and then some people start to discuss, okay, when the China is going to surpass US becomes the largest economy in the world, right? But then, so you may wondering, so what does this mean? How we compare the size of two economies with different population, with different characteristics, with different business, with different population. I mean, the distribution population, right? Okay, and then the answer is, so we are going to comparing the value of their production. But then still the question is outstanding. So they are producing so many different things in so many different ways and different quantity, quality. How we are going to calculate the value of the production, right? And then the answer lies in GDP. So GDP stands for gross domestic product. Okay? So this is the most important indicators for us to estimate the economy's size. Okay? So this is what we are going to learn. So now let's look at some background information before we go to the details of GDP. So to measuring the GDP or to measuring the size of the production for economy, so we need first we need a accounting system. So just like for an individual business, so we have this accounting, right? So at the CPA, so we have a school of accounting. So there are students who are measuring accounting. So accounting essentially you are trying to make sense of the business product, business practice of an individual firm. And similarly here, so we have a national income and product account, short for NIPA. So this is a accounting system for an economy or for a country, right? So we can use this NIPA or national income and product account to measure our nation's economic performance. But this can be any nation, or you can even think about to measure the state, the city, or even the village, right? And then so we can comparing two countries, or you comparing two cities, two villages, right? And finally, we can use this to track the economy's condition. Like say, for example, so the business cycle, so largely based on a good measurement of our size of our economy. Okay, so this is this NIPA account. So, but before I go to a circular flow diagram to explain how this accounting system works, now we need to do some preparation. So in terms of some concepts. Okay, let's go one by one. Consumer spending. So those are household spending on goods and services. So essentially the money you spend on a daily basis, right? So this includes tangible, T-A-N-G-I-L, tangible, and intangible, tangible, B-O-E. So what does tangible means? Just physical goods, like a computer, cars, house. Intangible means, so for example, the streaming service you purchased, the internet service, the movie you watch, or the legal service somebody provide to you. right? Those are intangible. Okay. So what is stock? Stock is just a share in the ownership of a company held by a shareholder. So for example, you buy a share of Apple for $150. So that just means you have a small ownership of Apple or Berkshire Hathaway, right? So you claim a share, okay? Because eventually, so a company is just a legal entity, right? So eventually, regardless how complicated the legal structure is, it must owned by some individual. Right? Bond essentially is just I owe you. So I owe you. Okay, I borrow money from you, either as an individual or business. And I promise I will pay you back. And as a return, I will also give you some interest. So this is a cost for borrower, but this is a reward to lender or creditor. Now, next one is government transfer. So this is a payment made by the government to individuals. Now you need to pay attention. No goods or service is provided in return. So the good example is tax credit. Okay, the government gives to a family with child, or the Medicare service. Sorry, the Medicare money the government provides, right? And here, so I want to emphasize the difference between government transfer to government spending or government purchase of goods and service. And transfer, no goods, service provided. But the government spending, so the government spend money, and as a return, so they provide a good and service. Think about the government spend national defense. They purchase a airplane, right? Or they purchase a submarine from a contractor. So this is government spending. Other example, the government invest in infrastructure, renovate the highway system, right? So as a return, so their goods and services was provided. Right? Lastly is disposable income. So this is income plus government transfer minus tax. So this is your income, pre-tax income, plus transfer, let's show PR, minus tax. So essentially, this is money at your free disposal, right? So this is your, let's call it net income, NET, net income, right? Okay, so with those as preparation, now we are going to look at a circular flow diagram to understand how we can keep track the value of goods and service our economy produce, right? Where we start? We start with the simplification of our real economy. And so also we start with put everyone into two categories. You either are households or you are firms. So what is households? Households is individuals or family. What they do, so they are going to buy goods in the market. So they buy different goods. But then, so how they can afford to buy those goods? So usually, so they get some income in this factor market. But what is factor market? So think about labor market. Or think about the market for investment. Or think about property market. Right? So how they make money or how they earn their income. So in the labor market, the household is going to provide their labor or they work for business. in investment market, so they just lend their money to the firm. So the firm has capital. Or in property market, so they just rent their property to firm. So with this income, they can buy goods and service. Okay, so this is the first player. Now the other player in an abstract economy is a firm. What firms do? So they produce, right? So they produce all sorts of goods and service. But in order to produce what they need a factor. What are the factors for modern economy? So this includes physical capital, labor, land, building, right? So to summarize, now so we are ready to look at this flow chart. Government spent, right? So they purchase goods and service in markets for goods and service. But those goods and service are produced by firm. So if we can keep track of the flow in this part, we know the GDP, right? Because everything produced eventually purchased by the households. On the other hand, so the firm, they produce. So they use resources, including labor, capital, building, land, so on and so forth. So they must pay a cost. So this cost will show up as income to household, including wage, this is for labor, interest, this is for capital, rent, this is for building. And then so you may end up with some profit. So this is profit in accounting, in the sense of accounting. And then the profit goes to ownership of the firm. But again, so eventually the firm owned by individuals, right? So you can see, so everything we produce here will exhaust it as income. The income goes to households. So now from here, so we can see there are at least 3 ways to look at the production of goods and service. So we can look at how we spend, right? Because we are going to purchase all the goods. Nothing is going to be wasted. Second, we can look at income, right? Because first, your spending must finance by income. And secondly, everything you produce eventually will convert to income, right? And then lastly, so we can look at what we produce inside business. So from here you can see, so this simple structure tells us 3 ways to look at GDP, right? Okay, very good. Now we are in a very simplified world. So it is very simplified in the sense, first, there's no government. Second, let me write down. So first, no government. Secondly, this is a closed economy. Third, no saving. Right? So we just spend all the money we have. Closed economy means so we don't do trade. No government means just no government, no tax. Okay, but in reality, it's not, right? So in reality we have government. In reality, we do business with others. In reality, we don't spend all our income, right? Okay, so now let's see how we are going to add those things one by one. Start with government. What government does? So they provide certain type of goods. So if you give them a national defense, right? So from your micro class, you may understand, so why we need a government to provide national defense. Okay, so this is public goods. So no individual is able to provide without collect all the benefit, right? Because you need a government to provide. If some individuals, if you give them a Jeff Bezos provide national defense, Okay, so it's very difficult for him to collect all the costs or to collect all the benefit other people enjoy. What that means is if he as an individual provide national defense, okay, as an individual, I may refuse to pay and he has nothing to do with me, but I benefit from the national defense he provides. Okay, so this is a good example. So that's one reason why we need the government. Okay. So now, in order to finance those public goods like national defense, government need income. Where the income coming from? From tax. So besides that, the government also provide transfer. So usually these transfers goes to elderly, goes to poor, goes to whoever need help from the society, right? And also the government purchase goods and service. Think about the government purchase military equipment. Think about the government purchase service to build up infrastructures. Okay. Now, with the introduction of the government, how that changed the calculation we have. So the main difference is, so remember earlier we say, okay, we can look at expenditure or spending. So now if we keep this approach, you not only need to look at household spending, you also need to look at government spending. You add these two together so that you can keep track of the total spending, right? So this is the introduction of government. Now, next one, as I just mentioned, so we are not going to spend all our money. We are going to save a fraction, right? So when we save, means somebody else need borrow, or when you borrow, means someone else will save. Okay, and then so we rely on a financial market, and then so what happens in the financial market? Households, they just leave aside a fraction. They don't want to spend, or they want to save for future. They put in the financial market. And then who is going to borrow? Government is going to borrow, right? Because sometimes the income the government can collect is less than what they're going to spend. So not only government borrow, so the private firms, they may also borrow. Right? So why they want to borrow? So they want to expand their business by investment spending. Okay. Now, so how the introduction of this financial market affects the calculation? So we need to look at, so for example, if we look at spending, not only consumer purchase, we just add government purchase. Now, furthermore, so the firm themselves, they also purchase goods and services. But the way we understand that here is use examples. Say, for example, Amazon want to expand their cloud computing business. And then they will purchase some hardware from NVIDIA or purchase hardware from IBM, right? So, but before, without this investment spending, so everything IBM or NVIDIA produced were consumed by households. Now the business also consume stuff they produced. Okay, so this is called investment spending. But this investment spending money comes from financial market, right? So this is the second, right? So the first we add government. Secondly, we allow people to save and borrow, right? Now, to finish this, the big picture, we introduce rest of world. So this is think about our trading partner, Mexico, Canada, Germany, China, Japan, Saudi Arabia, right? And so what we do, so we are going to export some of our high-tech product, like iPhone, like NVIDIA chips, right? Like submarine. Okay, but at the same time, we import from the rest of the world. We import avocado from Mexico. We import clothing from Jordan, right? And we import car from Germany. We import oil from Saudi Arabia, right? Okay, so now let's see how this changes the calculation, right? So if we look at the spending, again, consumer spend, government spend, business spend, or in other words, so they purchase goods we produce. But now also the rest of the world, they consume or they purchase goods or service we produce. But we need to subtract what we imported from the rest of the world, right? So this is spending. Now the last things, the very last things we need to figure it out or just complete this picture is, so just imagine if we export less than we import. Like I explained in previous lecture, so that just means we spend more than we earn in international market. And then how we are going to finance this additional spending? So this must through borrowing. Okay. Through borrowing means, okay, so we borrow from the rest of the world, or it could be the case if we have bigger export than import, means we have surplus, we have saving, and then we lend to the rest of the world, get through financial market. So now they just finished the big picture, right? To summarize, so we can either look at what's going on in the market for goods and service by looking at spending, this first. Or we can look at factor market to see how the income is distributed or collected. Those two. Or third, we can just directly look at what's going on in production. So we just look at the product. All right. So there are three from this diagram. So first, you need to realize how this complex system works by looking at this simplified representation. And secondly, from here, so you should realize they may have three different ways to look at the same issue. Okay. So in the following few slides, so we have those concepts we have already discussed. I leave this reading for you, okay, because I already explained that. So please just take time to read those. So there are 3 slides. Yeah, but I may just emphasize this one. It's government purchase of goods and service. So this is different from government transfer. Now, so there's a goods and a service return to the government, but a transfer, no return of goods and service. Okay. And import, export. So we're going to talk about that here. So there's a concept of inventory. So what is inventory? Inventory is the stocks of goods and raw material held to facilitate business operations. Just think about if you go to local car dealership. So usually they have some new cars in their garage or in their parking lots. Why they need that is because to make sure if there's a customer walks into the door, they want to buy the car, there's a car for them. So this is called inventory, right? But then if there's a change in inventory, say for example, so just think about car dealership. At the beginning of the season, so they have 10 cars. Every month, so they have 1 car comes in, and then they sell the car, Like in every month they can sell one car, and then this break even, so there's nothing changed in the inventory, right? Now think about another example. Okay, let's just use a big number to understand. So the car dealership, they have 100 cars. They feel very rosy about the sales market, and then they decide to bring in 50 cars per month. But turns out they can only sell 10 cars per month. That means every month they have 40 unsold cars, right? And then what they are going to do with those 40 unsold cars? They're not going to destroy those cars, right? And then they are going to put these 40 cars into here, into inventory, right? So these 40, and then we treat as investment spending, right? Because so this unsold car, they can put in their garage or parking lots. They can sell in the next season, right? So that's why investment spending includes change to inventory. But what's the change? Let's just repeat. They start with 100 cars. They bring in 50 per month. They sold 10 per month. For each month, they are going to have 40 unsold. So this 40 is the change in inventory. This 40 is investment, not this 100. All right. Okay. So now we are ready to look at the definition of GDP. Right. So what is GDP? So GDP stands for gross domestic product. Right. So in this long sentence, so I would like to break down in 3 parts, actually maybe 4 parts. Okay. So first, GDP is market value. This is number 1. Okay, market value. So the simplest way you can think about is, so the price you can sell in the market. Okay. Secondly is all final good and service produced. Now here the key word is final. Okay, just give you a preview, but again, so we will discuss in details. So what is final? Okay. So this pen I'm using to write on my tablet. Okay. So this is a final goods because it's consumed by me, right? But before I purchase from the maker of this tablet, so this pen was purchased by the tablet maker, right? And so in that process or in that purchase, so we shouldn't count as final goods because the tablet maker, they purchased this pen from a third party. But the reason why they purchased that is not for their own consumption. It's because they eventually they want to bundle with the tablet, sell to me. Okay, and then so in terms of value of this pen, so we can only count once, otherwise we have double counting. Right, so this is why we emphasize final. Now, third thing is within a country, but this country just emphasize the geographic notion. So this can replace with state, city, or village, if you like. Okay, these 3. Last 3 is in the year. Again, so this is not essential. You can replace this with quarter or month. Okay, so this says, okay, given a fixed amount of time inside the boundary of the economy, the market value of what we can produce, or this final goods. Okay, so this is the definition. Okay? And then The GDP we can calculate through 3 different approach, but this largely linked to the circular flow chart we have discussed. Okay? So basically, so you can either look at total value of goods produced. So this is the definition. Or in other words, so this look at firm production. Or we can look at spending. But remember, this is spending on domestically produced. Meaning if there's import and export, we need to keep track how many goods was shipped outside and subtract how many goods and service was imported from outside, right? And lastly, we can look at income. So the logic is, okay, all the income, everything we produced must pay a cost. And the cost will show up as income. Or in other words, let's go to the next slide, right? So first, spending equal income. Why? Any penny I spend goes to somebody else's pocket, right? So like this background picture. So this gentleman get a haircut or get the shave, and then the barber is going to receive, right? So number one, spending equal income. But income also equal to product. Why? Because you produce those goods and service, you need cost on factor. Cost on factor, you must pay the cost, right? And then, so those costs is your cost, but it becomes the owner of the factor's income, right? And also include the profit, because profit also is the income. So everything you sold will exhaust by all sorts of income. So that's why we have spending equal income, income equal to product, right? But finally, so product will also equal to spending, because everything we produce will be purchased by someone, even though there are unsold goods, and then we call this inventory change. But that you can understand, the firm just purchase back what those unsold, right? So these are 3 approach, they're equivalent. Okay. Now, to understand the GDP, so let's look at a few details. Okay. GDP is produced. Okay. It measures production. That means sales of used goods not included. It's because so used goods is not produced in current period, right? The sales of financial assets, they're not GDP, because the financial asset is what? It's a claim on your production capacity, right? But however, I want to emphasize, even though the sales of goods, used goods, or financial assets, they're not in GDP. But usually, in order to make this transaction go through, so we have some, we could either call the real estate or realtors, right? So we have realtors. So we have realtors. Or here we have financial advisors. Okay, so they provide service so that the transaction goes through. So their service they provide is GDP. Usually it's a small fraction, like 2% or 3% of the value of the goods. All right, so need make sure you differentiate these two. Okay. Now the other things I want to emphasize is within a country. To understand that, look at example. Cars produced in Mexico by American firm. So the production happens in Mexico, hence it's not in US GDP. Cars produced in United States, even though the firms owned by Japanese, they are in US GDP because this happens inside United States. This is domestically. All right. Okay, now let's look at this practice question. So there are two cases. One, price paid by German tourists when staying in New York hotel. So this essentially the good and service produced inside United States, right? Because in New York. So this included in US GDP. Two, price paid by American tourists when stay at the Berlin hotel. So the goods and the service was produced in Berlin. This should include in Germany's GDP, right? So the answer is C. Okay. Lastly, so GDP is inside a calendar concept, right? But again, so you can replace this with quarter, or you can replace with month. Okay. So now we can click this link to see the actual number. Okay. BEA stands for Bureau of Economic Analysis. So this is a US government agency that is responsible to calculate GDP. Now, so if we go here, so you can see the details numbers. All right. Okay, now back to slides. To summarize, what are included and what are not included. So it's better to understand what is not included, because what is included essentially is the definition. Okay, so what is not included? Start with easier one. Goods and service produced outside. Okay, that belongs to somebody else. Financial assets, because that's just the claim of the goods. Used goods, because that was produced in previous period, right? Input, because that's just an intermediate state. And lastly, intermediate goods. This is similar to input. If you include input and intermediate goods, you're going to face a double accounting problem. We will see that through examples in later lecturing, right? Okay, so the one more thing I want to highlight regarding to this concept is the GDP usually give us a incomplete picture regarding to what we produce. Okay, so give two examples. Example number one. Okay, so inside most families, so there are goods and services produced, but those goods and services never reported to BEA, which is Bureau of Economic Statistics. Think about, say, for example, so in your family, so you may do the lawn mowing for your parents, right? And so it is a service you provide, right? But so I guess no one is going to report this to the government, or the government is not bothered to ask you to report that. Other example, so sometimes you may do some like babysitting or dog walking for your parents, right? But again, so usually this is not reported. Or to summarize, there are many economic activity happens inside family. There are goods and services produced inside households, but they never get reported, right? Other example, so we have some illegal transaction, or we have some underground economy. So usually they never get reported, right? So you may have some experience. You go to some store, grocery store, or restaurant. So they accept cash, right? some of those cash transactions never get reported. But certainly there are goods and service was produced but never reported. So to summarize here, so the GDP usually underreport, right? And usually, so this underreporting problem is worse in a country with weak institution, right? Okay. All right, so let's stop here for this lecture, right? And then so in the next time, so we will continue with 3 different approach that explain to you how we calculate GDP.